Good evening, and we will continue our discussion on certain issues relating to equity. As we saw in the last class, the equity consists of the capital premium, the capital, retained profit, common stock, preferred stock, wherever it is issued. We saw that the equity can change if there is a dividend, if there is a further issue of capital, or if there is a distribution of stock or a cash dividend. In Indian companies, you can see, I picked up an Indian company like Hindustan Unilever. The equity is changing because of the issue of capital, because of the reserves, that means the retained profit. There is another item which is visible here is the revaluation reserves, maybe because of the changes in the bringing the assets at the fair value. So, whether it is an Indian company or an US or UK company, the concept of equity is more or less same. In some countries, in some cases called shareholders fund or net worth. What we will try to do today is understand the impact of the book value on the book value of the business decisions. We saw that a book value is the asset backup per share, or book value per share is the equity per share, which can be calculated as the equity divided by number of shares, and the number of share is 50,000 divided by 10. So, the book value per share is 60. Will this book value change because of the business decision? That is the focus of our discussion today. Let us take one decision. For all the decisions, I am keeping this balance sheet constant, and we are trying to find the changes in the book value on the same date, that is 1st April 2009. So, what is the decision? We are now issuing bonus shares in the ratio of 1:2. So, that means converting the profits or distributing the dividend in the form of share. So, what happened? The reserves are converted to capital. So, as a result, the number of shares will go up. So, equity will be now capital plus reserves, and the reserves will go down and capital will go up to the extent of 25,000, and the number of shares will go up to the extent of 2,500. So, the book value per share has come down from 60 to 50. The book value has come down because the equity remaining constant, the number of shares have gone up. Now, let us take another decision. If the company issues bonus shares in the ratio of 1:2, will the equity change? As we saw in the previous case, the book value may change, but the equity will remain constant. In the sense, the profits are converted to capital. So, it is a capitalization of retained profit. So, the total equity will not change. So, no change in equity. However, as we saw in the previous case, the equity remaining constant, the number of shares goes up. So, therefore, the book value will fall, not the equity. What will happen to the book value per share if the entire retained profit is distributed as cash dividend, not as a stock dividend? If entire retained profit 250,000 is distributed as a cash dividend, cash will reduce and the retained profit will reduce. So, as a result, the assets of the company will come down. All other things remaining constant, the liabilities, the equity value will come down. The other way to understand is capital plus reserves minus the dividend is the remaining equity, which comes to 50,000 divided by number of share. So, book value drastically falls here because you are distributing entire retained profit. On other word, to that extent of 250,000, your assets have come down because the cash will no more be there on the balance sheet. So, if the cash dividend is distributed, then the book value falls because of the assets. What will happen to the equity? If the loan is repaid by issuing shares of ₹10 at 50, that means in this case, we want to convert this loan into the capital. So, the loan is converted by issuing the shares. So, the new equity will be capital plus the new capital plus the reserves plus premium So, the capital was there, the new capital that you are issuing is 20,000 because you are issuing capital at the rate of 10 and issued at a premium of 40. So, therefore, the number of shares issued is 2,000. So, the capital goes up by 20,000 and the premium is 80,000. So, as a result your equity goes up to the extent of 100,000. In a simple understanding, the loan is converted to capital plus reserves or capital plus premium. So, the equity goes up. What will happen if the equity on equity, if all the investments, in this case the shares are sold at a profit. So, if all shares are sold, what is the share now? 100,000. If all the shares are sold at 300,000, that means the company is making a profit of 200,000. If assuming no other expense, no other incomes, entire 200,000 is retained. So, the equity after the sale of the share is capital plus reserves plus the profit on sale of share, which is 200,000. So, the equity will go up to 500,000. In other words, the equity of a company will increase if the investments are sold at a profit, assuming all other things remaining constant. What will happen to the book value per share if the entire loan is paid off in the form of cash? We saw in the previous case, loan is paid off by converting the loan into capital, but here we want to see the loan is paid off by cash, not by conversion. So, as a result, loan will not be there on the new balance sheet and cash will go down to the extent of 100,000. In the principle, as a result, the equity will not change because the equity is a capital plus reserve, which is 250 plus 50, or equity is 450 minus the cash minus the liabilities, which is 300,000. So, equity divided by number of share is the book value per share will be 60. But at the end of the year, assuming that on April or 31st March 2010, no incomes or no other expenses, operating expense, what will happen to the book value per share? Even if no incomes, there are expenses like interests have to be paid and depreciation on the plant has to be charged because of accrual and matching principle. So, the equity will be capital plus reserves minus the losses or plus the profits, but in this case loss. What is the loss here? Is the interest and the depreciation for year 10,000. So, the equity will fall. Since the number of shares remaining same, the book value falls to 56.4. So, what did we see? The equity will change if there is a changes in a business decision, and if the business decision maybe take a shape of a issue of capital, buyback of capital, profit retain, or any decision which affects the profit will affect the book value per share. So, therefore, sometime understanding a business can be actually understanding the book value per share. Pick up the book value per share, observe the book value of share over a period of time, then you understand the business decisions taken by them, by the business firm, and its effect on the book value. And my assumption is the market value depends on the book value per share. In our next session, we will focus on the statement of changes in equity, which is required as per IAS 1. Thank you very much.